If, in fact, it becomes the case, this goes on a long time, the trade dispute, and it does affect China growth that materially to take it below 6%, what does that mean for markets? Because thus far in the equity markets, we've had a sort of tumultuous week, but it's all come out okay.
Right, not too bad so far, right? So I think about the risk along four dimensions. You've got monetary policy, you've got trade and geopolitics, you've got markets, and then you've got the economy. So there's a system here. Right, and I think right now what we're waiting for is to try to understand the extent to which the trade uncertainty is leading to potentially greater flagging of economic growth. We've started to see some of the stats soften a little bit. I'm concerned about PMI globally. I'm concerned about Europe. That's starting to weaken again. And then I think the markets, right, there's a system of hedging and risk taking. And at some point, I think a worry for us at Macro Risk Advisors is that the bad news and the overhang of uncertainty from the ongoing trade negotiations, which doesn't look like it's going away anytime soon, it starts to just weather people's ability to take risk.
So there's lots of different areas where you don't see the risk, but one where you're starting to see it is dollar yuan, and sort of the yuan breaks above 7.
Yeah.
How do you deal with that? How do you deal with that view?
Well, it's an interesting currency to watch because we ultimately know that it's highly managed, right? To the extent that the PBOC wants to keep it above 7, below 7, that I think that they can. We saw, real challenges the last time this happened when oil was crashing. That's not happening right now. We saw big outflows from the currency, but that's definitely something that we're supposed to watch carefully. One of the things we do is we look at the correlation, for example, between CNH and the VIX. That was a big market narrative back, again, when oil was crashing in late 15, early 16. That feedback loop felt very active. And so we've started to notice that correlation tick back up a little bit. Got a little reprieve here with the VIX coming back down from 20 to 16. But, there's all of these things that are interacting, and I would say in a not so favorable way. And again, I think what you'll ultimately need is for investors really to sort of switch into risk aversion mode. You're going to have to see corroboration that the global economy is re-softening. We'd seen an uptick in some of the PMIs early in the year. People started to buy into this notion that China's stimulus was working, but as this UBS economist has pointed out, maybe not so much.
So is risk underpriced at this point?
I think it's about fair. It kind of depends on where you look. If you look at the VIX, sitting here about 16, you're really supposed to look more at the VIX futures. So June and July VIX futures, those are at 16.5, 17. It's about fair. It's a little bit of risk premium in there. So you really, if you're hedging, you have to be creative. And one of the things that I think is a compelling hedge is gold. So gold is negatively correlated to the S&P, especially negatively correlated when the S&P goes down, about 30% negatively correlated. It's also moves very inversely to real interest rates, which have been coming down as concerns about the economy increase, and this view that the Fed's going to do something increase as well, right? The implied rate cut moves have moved up. And then gold vol. So, we spend a lot of time on options, and we look at the price of options on gold. Call options on gold are extremely cheap. They're cheap for a reason. It hasn't really moved that much, gold. It's sort of acting like a currency, which currency volatility has been very muted. But I really like gold options, gold call options, as a part of the hedging portfolio. I think it's a creative way to own some convexity, as we call it, to a risk off.